Well, greetings and welcome to another episode of the Deal Flow Show. I'm JP Maroney, your host, along with Paul Nicolini, my co-host here at Harbor City Capital and the Deal Flow Show team. And we've got David Weild with us, David Weild IV from Weild Capital. And I want to talk to you about a lot of things, but I know that you've got a massive depth, in fact, about as deep as you can go in the Jobs Act and the whole idea behind the Reg A's and a lot of the things that we know today with crowdfunding. So I want to talk about that today. But let's go back just a little bit and let our listeners and viewers know how you got started in the capital markets. What was the beginning for you? Maybe talk a little bit about some of those early deals that you worked on.
Sure. Well, I was a molecular geneticist and was doing graduate work, and I saw Genentech go public, and I put together the notion that capital could transform the world, right? I saw that as sort of the dawn of a complete revolution in how medicine was going to be had, and how disease could be cured. And so, I looked at capital markets as really being, where the God's work of investment banking and innovation was done, where jobs were created, where solutions were found. And so I became a kind of a real student of markets. I wanted to be a venture capitalist, but at the time it was a bad economy and nobody was hiring anybody, and so beggars couldn't be choosers. And I found a guy that wanted me to be an analyst in an equity syndicate department, taking apart other people's deals. And so I flew all the way out to Colorado to take that job. I mean, his view was, he can do that, he can do this work in securities if he can do the molecular genetics piece. So I took the job, and I was really good at identifying sort of hidden gems in deals, and so good, in fact, that I was telling the guys at Merrill Lynch more about their deals than they knew. And so their heads of ECM was a guy named Peter. I'm trying to remember Peter's last name right now, and then Ted Coburn, got on planes and flew out and tried to recruit me over to Merrill Lynch, back to New York from Colorado. And then one day, one of them Ted moved over to Prudential Securities and brought me back to New York to work on a deal as a co-manager, and then cornered me in a room and quadrupled my compensation and made me an offer I couldn't refuse. So I came back, started working for Prudential Securities. I ran, I was working on the equity syndicate desk, putting in new technologies, created the first algorithmic allocation programs for new issue equities, and did a range of things. And very quickly, when he left, became the head of global equity capital markets for Prudential Securities. And look, I had a great time. I priced over 1,000 public equity offerings, did 500 IPOs at the time. I worked with, I raised money with Celgene, which just got sold to Bristol Myers Squibb for $74 billion back when it was a $100 million company. And, and then, had the honor and the pleasure to, create or work in financing drugs that have actually saved the lives of friends of mine. So, so it's been, I've never lost the enthusiasm for, doing what we need to do to fix our markets, to make them work for the American people and for the next generation. And so that's kind of where my passion was. That's what Weild Co is all about. We're creating an alternative investment banking model, which is, and we want to scale the hell out of it. We want to take it we're up to 90 professionals. We started in August of 2016. We've got about 80 active engagements right now. We want to take it to 1,000 professionals over the next 5 years, and then take it public and fill in that gap that's been voided by the collapse of the middle market firms when they collapse trading spreads and commissions by changing market structure. And at the meantime, we're out there trying to fix capital markets so that we get more and more and more of the 30 some odd trillion dollars in public markets to tilt downward into the hands of entrepreneurs to set off a growth revolution. That's what it's not, it's not about just making money. It's about really if you're passionate and you put on your red, white, and blue epaulets and you care about this country, it's about, creating the toolkits that are required so that capitalism can really do its thing. There's nothing more powerful than people, working out of enlightened self-interest, but doing it in a way where when they make money, they're actually achieving something which is beneficial for society. It's about incentives and disincentives, checks and balances. And if you get them right, there's nothing that will stop us. If you get it wrong, you're going to get some horrible unintended consequences. And so I think that for those of us that have been around for a certain period of time, it's kind of up to us to, make sure that we put the guardrails in the right places and leave an infrastructure for the next generation. So I think that what we're trying to create with Weild Co is, it's a network of independent contractor investment bankers up to 90, 17, 18 states in the District of Columbia. We've got our first couple overseas. I mean, we want to create a machine to go and fill this void in the middle market, which is thirsting for investment banking services, and get people to effectively do those things that are going to create great solutions to major problems and create jobs and restore upward mobility and all the things that I think that most of us can agree on.
I have a lot of questions, but one of them, you covered a lot that it sparked some thoughts. When you talk about this middle market, serving it and building a massive amount of bandwidth, are you talking about with traditional services, or is there a new model? Is there a new way of looking at how you deliver these services to the market?
A little of both. I mean, it's a lot of traditional investment banking models, but effectively virtualized in the cloud in an independent contractor model. So, I ran a top 10 investment bank years ago. I was in charge of strategy banking for banking research, sales, and trading. So got really deep in the weeds of what works and doesn't work. And you ultimately need, if you're going to get better and better, you need specialization. You need critical mass in certain verticals. And so, through an independent contractor model, we can attract more human capital because we need less capital to pull people together to get to that critical mass. And ultimately, in the cloud, we'll start to virtualize groups of common interest, which may be industry verticals, product verticals like M&A, private placements of debt, of equity, of asset managers, and then ultimately sales groups. So we're, at 90 professionals, we're just in the early throes of creating some interesting verticals. We've got a really good emerging blockchain group. We do some things in life sciences and medical devices. We've got a great insurance investment banking group. We're starting to get some folks that are really good at doing secondaries. So, for example, in a private secondary. So, for instance, we've got an ongoing engagement for a B2C company that's growing like a weed during COVID. And we have more and more of those. We just attracted a guy that was running a secondaries fund in Silicon Valley, has a PhD and out of Cornell. So really incredible talent that's starting to flock to us.
You had a question?
I did, yeah, a couple, but I'll start with one. You are often referred to as the father of the Jobs Act. Can you give us an idea of what your role was with that and how you got that passed?
Yeah, sure. I wrote a series of papers, the titles of which were things like A Wake-Up Call for America, that looked at the drop-off in the small IPO. And most people think it was decimalization or Sarbanes-Oxley. In point of fact, it happened before that during the height of the dot-com bubble. And we were able to demonstrate that the cause of the drop-off was the shift from telephone quoted markets to electronic markets, the collapse in trading spreads and commissions that occurred with self-directed brokers. So brokers couldn't then in the aftermarket market stocks. It's really an aftermarket problem. And so, we had a very, very dramatic chart that was passed around Congress that showed that we had 80% of all initial public offerings were small initial public offerings, and in 1 year it dropped to 20%, never recovered. That was a market structure shift. It wasn't, for a long time, people would make fun of me saying, Weild doesn't know what he's talking about. It's a market cycle issue. And I said, no. You can just put it up on your screen, watch it. These small IPOs are not coming back because you drop the bottom out of it and the market structure is not going to support them. And so in the meantime, we just said, we wrote another paper, the paper called The Wake Up Call for America made recommendations for private and public markets, and they took some of those recommendations. The repeal of the prohibition against general solicitation, which became a 506C private placement, that came directly from that paper. I actually testified and probably wrote about half of the provisions into Regulation A+. Back all the way when it was HR 1070 before it got rolled into the Jobs Act. So, even the former chairman of the House Financial Services Committee referred to me as the father of the Jobs Act because our written work actually told Washington that we had a problem. So I like to say that it's not exactly the act that I would have written if they'd given me the pen because, our process is a collaborative, compromised, infused process, and there's a lot of horse trading that goes back and forth. And so what comes out the other end is political compromise, and you kind of have to stick at it and keep moving it and sort of refining it. There was a second act that was, I would say, kind of had a technical corrections part called the FAST Act, and we actually got really close to another much larger package that was called the Jobs and I think Investor Protection Act, and it was in 2018. It actually passed the House 406-4, and it was supposed to get tacked onto the Senate Appropriations Bill and then passed into law, and Trump was supportive of it. But then they went to war over the wall, shut down the budget over the wall. It pushed it into the next Congress, which has the effect of mooting all legislation, right? So you have to take it back up again. Then we went into the presidential silly season when nothing except for basic budget stuff gets done. And so as I like to say, getting legislation passed is like being a midget in an NBA game. If you hang out in the paint long enough, eventually you're going to get a rebound, even if you're 4 feet tall. So we're hoping to hang out in the paint long enough with Congress because what we offer is heavily bipartisan. I mean, we have in fact a little bit of trivia is that the gentleman who is running the transition team for President-elect Biden was actually one of the first advocates for trying to bring back the small IPO. He actually did a speech on the floor of the U.S. Senate to that effect. So,
what's the definition of a small IPO?
well, then it was sub $50 million. I mean, he in his speech he said 25 million. He took the midpoint, 0 to 50 million, and he said, I think the closing line in his speech was, if we can get the $25 million IPO to work again, we'll get America back into business. This is Senator Ted Kaufman, and Senator Kaufman took over. He was the chief of staff for Senator Biden, and when Biden became vice president, he gave Ted his seat, and Ted was holding the seat warm for Beau Biden, and of course Beau tragically passed away of a brain tumor, and so as a consequence, Ted was in there for that one term, but because he wasn't running for office, he did what was, he advocated for that which he believed in, and he's a Wharton graduate, and so when we were showing him and going through the slides, I mean, Ted's a very smart guy, and he picked it up just like that, and became a great advocate for trying to improve capital formation broadly. Most people don't know that. Of course, the Jobs Act was signed into law on April 5th of 2012, and it was signed into law by President Obama. And I was in the Rose Garden when it was signed into law.
You talked about doing or being a part of over 500 IPOs. Historically, when you look at the deals you've done, and then the things that you see going into the markets today. What are your thoughts in terms of the valuations? Some of these sort of still almost feel like pipe dreams that are entering the markets. Some of them don't seem to have a lot of substance to them. You and I were talking about, Paulie and I were talking about Crunchbase and seeing some of those deals come across your email, and you're like, what?
How'd they do that?
Yeah, how are they getting those valuations? How are they even getting money? Do you feel like the market's there's such a vacuum right now, so much appetite, or what do you think's driving that?
The question is, there's a lot of liquidity. We've kept interest rates low. Partly because of the unemployment problem, but this has been going on for a while. You also have a demographic, issue, not just with the United States. It's worse in Europe. It's worse in Japan. And so there's a fear that if you slow down the economy, you could end up in not just in a recession, but you could see deflation, and people are afraid of deflation, right? Because the consumptive side of the economy is a lot softer than it once was because of we've tilted much to demographically to an older verging on retire. And remember, the median age of the baby boomers is now 63 and 63, 64. Right, so they're on the verge of retiring. So you've got this big bolus of people that are starting to retire, and that means that they're living on fixed incomes. They're not spending as much money. They're downsizing, and now we've got this massive unemployment problem because of COVID. So I think we're on kind of tenterhooks. We're flooding the system with liquidity. You saw that the government, I think, pumped about $3 trillion of liquidity into the economy. And, we're trying to hold it together until we can come out the other end. And so where are you going to go with the money? Well, the commercial real estate sector is troubled right now. I was, my dad's retiring from the practice of law. We were down at 200 VC Street in Manhattan, which is a massive, in the World Financial Center, a massive office building. And I asked the securities guards when we were down cleaning his office out, what is how many people a day are you seeing in the building? And he said 70. And I said, what were you seeing before COVID? And he said 70 to 90,000 people a day went through that building. 70 to 90,000, not 70. And so, so when you start looking at WeWorks and places like that, you can go visit. You can almost hear a pin drop in these places right now in Manhattan, and yet the traffic in the streets, you have traffic jams. Why? Because nobody's taking mass transit, right? They're trying to avoid COVID. So, we're starting to teach ourselves we can live in a distributed work environment, particularly in the professional services space. We can work from home. That's our model, right? So we've seen a sudden surge in interest from investment bankers because it's already what we were doing. We had 30% growth in new professionals in the first 6 months of this year, right? And it's all word of mouth. So, and some pretty fantastic people. I mean, we just got a referral, I think I mentioned to you, from somebody who was at Barclays in Singapore, right? So, I think the world is in the process of changing. I think it's changing permanently. It won't be as extreme as it is currently, but it's going to be, forever changed. And you're not going to see the concentrations of older professionals and families in places like, Manhattan, because they no longer need to commute, many of them, right? That's going to change the economic environment, the tax base. I can't tell you how many of these cities are likely to be, in trouble if you moved out of the city and you had an income tax, right? I mean, everybody's watching the clock. It started in March, right? They're going to be out of the city for 6 months. And I know a lot of people that are doing this at least 6 months because they want to avoid an income tax from New York City. So, that and the loss to the spending, which was the sales tax, the revenue base, the tax revenue base is going to be really, really, really depressed. And so, it'll be interesting to see. I mean, in some respects, not to play, this is not a political statement, but I think that the Biden administration is going to be more sensitized to the fact that these, cities in some of these states are going to be in crisis. And from a revenue standpoint, and hopefully help work with them to bridge to the other end, because you've got, uniform, first responders and things that are going to need to be, paid to keep the lid on and keep people safe and so on and so forth. And so we're going to go through a period of restructuring, which is going to take quite a while. And that's one of the reasons why, as an advocate for improving capital formation tools and getting, there's in round numbers, there's, call it $40 trillion worth of public equity assets, running around the equities markets. And I think over 30 trillion of that is just in the Fortune 500, right? To show you the concentration. And so if we can get, some of that money to tip down into private markets where jobs are created, we will create a much bigger tax base. We will help, pay off some of this deficit that we're creating. That creating this entrepreneurship revolution, if you will, is going to be absolutely essential to our long-term success and our ability to compete against bigger countries like, China over the long run. So I look at it as being, some things that we've got to get back to work. We've got to roll up our sleeves. Hopefully, hopefully people in whichever administration it turns out to be will be receptive to hearing ideas, because I think we can make a massive difference. Some of it may take some tax incentives, to channel money into places that need it, but with a capitalist bent sort of economic activism to create more businesses, more jobs, more upward mobility, and ultimately more things of value in areas of the country and sectors that are going to require it.
When you go back and look at all the deals that you've been a part of, what are the common threads that you look for in believing that that's going to be a successful deal? In other words, what are those deal makers for you?
I number one am in a bet on the jockey, not on the horse kind of guy. I like to say I'd rather have an A leader and a B idea than a B leader and an A idea. It's interesting because we're working with some artificial intelligence applications to the deal business right now. One of them does what they call collective intelligence. There's a whole lab set up at MIT on this, run by a gentleman I think named Maloney, another close cousin there, JP. But what this platform does is it uses panels of experts to evaluate deals, and it's shown that they statistically consistently outperform individual, for instance, venture capitalists in deal selection, but also by taking qualitative input from those 25 specialists or experts, turning it into quantitative output that you can evaluate, and then suggestions. So you may find out of it, for instance, a sales channel that's very productive for the company that you otherwise didn't know. And so we're going to see more and more of that going on. They're being deployed. There's a $100 billion plus endowment fund out in the West Coast that's partnering to further develop the application of that technology to how they run their endowment. We've got some of the exchanges and others that are looking at it as ways to, from a diligence standpoint, to evaluate. So there's a quiet revolution that's going on in artificial intelligence. I mean, we have a really, well, I think it's the most amazing first-time venture capital fund I've ever seen, and we work with a lot of them. That it takes it takes this artificial intelligence and evaluates all of the angel investors out there for track records and determines which subset of them are super forecasters. This is, if you know Philip Tetlock's work, the professor at University of Pennsylvania, and what you end up with is an ability to early on have a much higher probability of predicting future unicorns at an early stage. It's Moneyball for venture capital. If you know the Michael Lewis book, he was the author of Flash Boys, and very widely read on Wall Street. But that's what it is. It's Moneyball for venture capital. And for me, that is, I look at that, and if they get it partly right, it'll be a 1 percentile performer, kind of thing in the venture capital space. So, there's a lot of things going on. I'm interested in these technologies to apply it to the business of investment banking, right? And to not only to evaluate companies for the purposes of what do you offer to investors, but because the output, I believe, over time will help those managers become better managers, those CEOs become better CEOs. And so, improving, the allocation, the efficient allocation of capital and the return and the rate of innovation. I mean, all of these things are, I think, absolutely essential to long-term U.S. success and competitiveness.
I know Paul's got a question for you. Before we do that, if you're watching or listening to this episode of the Deal Flow Show, you can get access to our previous episodes and also subscribe and follow us for access to future episodes by going to thedealflowshow.com. That's thedealflowshow.com. David,
at Weild Company, what do you guys do to prepare yourself for a deal? And give us a sense of your due diligence process, if you will.
Diligence varies as a function of industry and the type of deal. It's very different. We use the ILPA, Institutional Limited Partnerships Association's due diligence questionnaire, for instance, for asset managers. In fact, it can be pretty painful, pretty extensive disclosure document. But the flip side is that, if you're looking at a life sciences company, which are almost inevitably pre-revenue, you have to speak to scientists, and you have to have some real, deep vertical knowledge, and you're evaluating the opportunity, on the basis of, lots of criteria. What's the cost going to be to get the thing ultimately public? Because some of these businesses have in the life sciences area have to mount trials that are going to be so expensive that they become prohibitive. So the financial risk is sometimes even more concerning than the clinical trial risk, right? Because you need the money to be able to do a bona fide clinical trial. And we went through this recently with a public company. I said on the board of, and I'd love to do an earlier stage trial. The problem is, which is on an outpatient basis, the problem is that in order to do that, you need a much bigger patient population, which means you need more money than if you were doing it in the hospital and you could control it, and you were dealing with only 40 or something patients. And the end point was, did you have a higher survival rate? When you're dealing, and I'm talking about COVID, for instance, if you're dealing with an outpatient population, you want to see how many people stayed out of the hospital, and a lot of people naturally recover. So you have to show that the term of the disease is shorter. So you end up with much larger patient recruitment challenges and follow up and implementation. So the cost of running the trial is significantly higher also in this particular environment, because so many people are competing. There's so many ideas coming at COVID, right? You're competing for patient populations, and we've seen it move from hospital to hospital, that smaller companies, you can find that all of a sudden, the curve crested because the state started, putting more people in masks and requiring it. So the infection rate declines, the number of patients declines, so the ability to recruit. All of a sudden you go and you're not able to fill up your patient populations. And so there's got to be a little bit of, on the diligence front, it's a much more bespoke, hands-on active kind of process as opposed to somebody simply filling out the questionnaire. And then for other companies, it's everything kind of in between. And obviously, alternative energy is a little bit simpler. We're seeing a lot of interest now in things related to the electric vehicle market, from lithium mining to support batteries to chargers to we've been working with a company that's actually creating an electric plane trainer, and interestingly, because just like with the Tesla, there's so many fewer moving parts, that the actual cost to operate these planes should be dramatically lower. So the cost to be able to train pilots should be significantly lower, which should grow the universe of people that want to get licensed as pilots. So, it's a little transformative to the industry in a number of ways, not the least of which is that it has a more climate-friendly footprint.
We've gone 35, 40 minutes, and he hasn't mentioned the buzzword, the key word of this. We've heard it over and over again from our guests. Give us your take on SPACs.
Oh boy. Well, so first of all, and I'll give you a different spin on it. SPACs are a symptom of a market that's not functioning properly. It's Wall Street ingenuity trying to figure out how to get companies public when the traditional IPO process is failing. Okay, so that tells you that Congress and whoever is going to be occupying the Oval Office needs to fix the stock market structure so that we can get support back into smaller IPOs and be able to take them and distribute them properly, do a proper underwriting, and get them to set up and support it back and get America back into business. Now, we worked on a new form of stock market that was supposed to do this. That was in that bill I told you about that made it through the House 406 to 4. It was called a venture exchange. It was with Congressman Emmer, Republican but it was very, very bipartisan up in Minnesota. And it was in that big omnibus package that got stalled when it went over to the Senate and the president shut down the government over the wall. Hopefully it'll come back. But SPACs, right now offer people an alternative to get public. And if there are more and more and more of them, we'll get more companies public. It'll create some velocity of capital to mid-sized companies. So on the margin, it's better than nothing, right? But the trick is there's a lot of dilution associated with it, which puts a limit on it puts a big pressure on buying a cheap company into the SPAC to get the conversion, to get to de-SPAC it, to get real investors to buy it. And then you typically have a warrant overhang or a partial warrant overhang. And so you got to see a lot of growth in these things to be able to drive through that incremental dilution to make the stocks perform in the public marketplace. And so, as I said, it's not a perfect solution. The flip side right now, and I'm going to connect some dots for you, is that there's probably 60 institutions that generate 90% of the commissions to the typical Wall Street public equity operation. 60 accounts. And the reason, and they're the ones that are effectively paying for access to the IPO calendar, right? But they're not the natural buyers. The natural owners of these stocks are lower turnover. The other, there's another 3,500 accounts out there that are doing more fundamental investment, but because they don't have the velocity in their portfolio, they're not generating enough commissions to get access to the IPO calendar. So what is Wall Street doing? Wall Street's chronically underpricing IPOs to those top accounts of theirs. They generate a pop in the stock price, and they are shaking them down for commissions over the transit. That's what's going on. And they may not say that, but basically they're saying, things like, we're only allocating new issue equities to our big commission payers. But what are they doing? They want to see more commissions. If I put $1 of alpha into your account, I want 50 cents back into my account, right? And so what's happening is the companies that are going public in that process are being underpriced, leaving too much money on the table. Boom, boom, boom. Now you hear about direct listings. What's going on? Well, people in Silicon Valley have figured out that they're getting screwed. They're getting way chronically underpriced and not properly distributed. So they want to direct list and avoid Wall Street altogether. And that's that tension. So meanwhile, you got SPACs showing up in the market to try and fill the gap. And so all of this here is telling you that stock markets are not functioning properly from the perspective of capital formation, and we need to go out and start with a clean piece of paper and structure a market that is going to allow people to provide aftermarket support. Now, I'll give you another concept, which is a little bit academic, so bear with me, okay? Large cap stocks are called symmetrical order book securities. Thousands of buyers and sellers interacting, okay? Best thing you can do is get out of the way and let the order book interact. Very efficient market. They're innately liquid. This is what you see with the S&P 500. But life starts always with smaller companies. All Fortune 500 companies were once startups. And so in order to get to that Fortune 500 stage, you got to cross the chasm. And the chasm is where the small IPO market was obliterated. Why? Because they're asymmetrical order book securities. Big buyer, no seller. Big seller, no buyer, right? There's not a lot of standing orders, right? So somebody has to get compensated to create an order to find buyers to offset the sellers. And when there's no economic model, because everything's trading in penny tick sizes electronically, and a short seller can get in if they sniff something and short into the deal, and your Fidelity or something is going to end up seeing their stock go down, and their $10 stock, they get out of it at $8. So the real cost is the $2 they lost in so-called slippage in share price. They just say, the heck with this. We don't like this market. Microcap markets are not working. We're going to move our capital up market. And so we've got a one-size-fits-all stock market that's optimized for large cap trading, and we don't have a market structure in the public that works for small capitalization stocks any longer. That's the burning, crying need for the U.S. economy. If we get that fixed, we will start turbocharging the economy and innovation once again. That's what we need, and that's going to look something much more like the old telephone quoted Nasdaq over-the-counter markets, if you will, where people get on the phone, they get long and loud. Fidelity comes in with 500,000 shares of stock. They're selling it on a stock that trades 10,000 shares a day, and the firm says we're going to buy it at 10, mark it up to a quarter net to the client, and we'll create 500 1,000 share buy orders to absorb that big bolus of stock that's coming into the market and replace it. We're going to tell that story 500 times to 500 investors and manufacture liquidity. We need to get back to that blocking and tackling, because the great myth of markets is that what you have that works for large cap stocks is a complete unmitigated disaster for small cap stocks. And it's costing this economy, and it's costing our populace jobs, it's costing us innovation, it's costing us U.S. economic leadership, it's costing us tax base, it's ultimately going to cost us national security, because national security comes from technology leadership, and technology innovation needs to be funded by capital markets.
David Weild Co. All right, now, so as we finish up here, our audience is obviously diverse, people from all across the capital markets, as well as founders and service providers. What are the kind of people that you would like to hear from, and what would be the best way for people to reach out to you?
Well, we're a movement as much as we're a business, and an independent contractor. If you think you got something to add, come join us, right? We want to take this. We're going to create essential economic infrastructure for the U.S. economy by being in all 50 states and growing to 1,000 people and getting ourselves organized so that we can be part of the solution and not part of the problem. If you've got, we're big believer in great deals and capital formation. You need help that way. Investors, we throw off so much deal flow, and we've got 80 active engagements right now, particularly high net worth individuals, people that are interested in investing, reach out to us. But again, if you believe in a movement that's going to be part of the solution, and not part of the problem. If you want to make a contribution and you think you can help, we'd love to hear from you. I'm on LinkedIn. It's David Weild, W-E-I-L-D. There's not a lot of Wields around. It's a pretty rare name. And love to hear from you.
Fantastic. Good to have you on.
At least,
Anything
well,
else?
there's at least 3 David Wields because he's the 4th, right? So, so we've got that.
There's a 5th at home. He's 6'3".
Oh, there you go.
Fantastic. So good to have you on. Obviously, if you're watching or listening to this episode, be sure to get in touch with us. If you think you'd make a great guest or you know a great guest, go to thedealflowshow.com and suggest to us a guest or suggest yourself. And if you are listening to this episode, we have a lot more coming in season 1, and we already have season 2 on the horizon. People starting to book for season 2. So super excited about the success that the Deal Flow Show has had in our very first season. Yes. On behalf of my partner here, Mr. Paul Nicolini from Harbor City Capital, our team here in the studio, Jesse McMinn behind the camera, Mr. Daniel Pinaranda, our producer. I'm JP Maroney, and we'll see you again in another episode very, very soon. Take care, everybody. Bye-bye.
Thanks, David.
For more episodes, visit thedealflowshow.com and subscribe.